I have been getting lots of offers in the mail, in my email, with credit card applications and personal loans, and I'm not quite sure which of the two are actually more beneficial to me. Should I take the personal loan route? Should I take the credit card route? Should I even take advantage of two or both? Are they even the same? So many questions, right? So if you're facing that dilemma and having the same doubts, well, let me tell you that you came to the right episode, because we're going to talk about it exactly today. Hello everyone, and welcome back to NOVARISE Invest. If this is the first time you're tuning into this channel, well, let me tell you, this is your channel for real estate education. So today we're going to talk about which one is better for you. Should you go the personal loan route or should you go the credit card route? And for that, what we're going to do is to jump straight into my iPad. All right, so here we are, but before we dive into any of the analysis, what we need to do is to first understand the breakdown of the FICO score. And here we have a pie chart. So for those who are actually brand new to the whole concept of credit, because we have people from all kinds of financial educational level, and we have also people from all over the world living in the US who this might be the first time you're getting introduced to FICO. It's just basically a scoring system to show your credit score, right? To see how responsible or irresponsible you are, and it helps you understand your weak points so you can actually work towards making it better. So here we are, we have a pie right here for the FICO score, and it's broken down into multiple categories. So we have the first one right here at 30%, and that has to do with the amount that you owe, right? So whatever amount of money that you owe in relation to all of your credit history. Then 35% of it, it's gonna go towards timely payments. That's why they say that you should never be late with any credit card payments, because if you are late, then it's gonna hurt your credit score in a negative way. Then we have, let's say 10% over here, and that has to do with new credit. So every time you apply for a credit card, that's why you always hear about the whole, oh, if you apply for a new credit card, your score is going to drop a couple of points because of credit pull. Well, that has to do with new credit, but it's only temporary. Eventually it will come up. And then you also have 10% here and then 15% here. So this 50% has to do with the length. And excuse me, I'm not used to writing in this tablet yet. So when I'm talking about length, we're talking about how long have you had your credit history for? Is it 5 years? Is it 10 years, 15, 20, sometimes even 50 years? So that it's 15% of your FICO score. And the remaining 10 has to do with credit mix. And this, it's what we're gonna cover today. So what am I referring to with the term credit mix? So let's say, for example, we have our chart here, and then we have credit cards on one end, and then we have personal loans on the other end. So what is a credit mix? It's a mixture of different type of credit. So a personal loan, it's a type of credit. A credit card, it's a type of credit. A mortgage is a type of credit. A car loan, it's also a type of credit. So that's what FICO is referring to with having that mix, which means that in this case, a personal loan and a credit card are a type of credit, but they're not the same thing, right? They belong to the family of credits. They're both used to report on your FICO score, to measure how responsible you are with the payments, and they're both meant to provide you liquidity so you can use that money to do anything you want. But in essence, they're not the same. So let's say, for example, you apply for a personal loan and you got approved $10,000. So you can use that $10,000 towards anything you would like to use, whether it's on the renovation of your kitchen, or maybe on an emergency, or maybe to pay for your tuition, whatever it is, you can use that at your discretion. But personal loans, they have a term. So what do I mean by a term? That means you only have a certain amount of time to pay it off. So let's say, for example, if you get approved, like I said, $10,000, you could get the loan for 5 years, 7 years, or 10 years, but that doesn't mean that the money is going to be available for that period of time. It only means that you have either 5 or 7 or 10 years to pay it off. So let's say, for example, if you borrow $10,000 and you paid it off in 2 years, then that's it. You don't get access to that money anymore. Yes, they gave you 5 years, but you paid it off early. Congratulations, good for you. And it won't appear in your credit anymore. It will still be part of your credit as a loan that you had, but it will no longer be reported on because you already closed it out by just paying it off. On the credit card, on the other hand, this type of credit is what they call a revolving credit, which means it goes around and around. Think of it as the example of a revolving door. Every time you go into one of those big fancy buildings in the city and you walk in, all you see is just a revolving door, which means you have $10,000 available. You can use part of it, you can use all of it, you pay it off, the balance is back to zero, and you can use it again. So there's no expiration date on it, quote unquote. Yes, you do see an expiration date on the card, which is, just a piece of plastic, but you will notice that once your car is reaching that expiration date, so let's say, for example, if your car expires in January 2020, you will then receive the car in December 2019 because it's meant to be a continuation. So the credit line in itself doesn't expire. What expires is just a piece of plastic because maybe they need to issue a new style of car, they need to enhance the security, for whatever reason, they'll issue you a new card, right? So those are the two major key differences between the two. This is a term. So in other words, a personal loan is very similar to a mortgage. A personal loan is very similar to a car loan in the sense that once you use it up, that's it. A credit card, it can go back over and over. The only way you can have access to the personal loan again is by applying to the loan again. So if you use it all up and you need it again, you have to go to the bank, request for an application form, and then apply it. With a credit card, no. All you gotta do, the only thing you have to worry about is to make sure you don't go over the limit, that you keep your limit control, and that you make your monthly payments, right? So you do not need to, no need to reapply. Another, I'm not entirely sure if it's a difference, but it varies depending on the market, but I will say interest rate. Usually personal loans have very high interest rate. They're usually starting at 24.99%, as opposed to credit cards that could start off at $15.99 or sometimes even $13.99 if you are lucky, depending on the bank, right? So you start off with a slower rate. Hear me out. Usually, right? Because sometimes, depending on your credit history, you might have a really bad FICO score. You might not start with exactly $15.99 or $13.99. You can start off with a credit card at 24.99%, just like you would do with a personal loan. So it's kind of like iffy in the sense that you don't truly know. That's why it's important for you to read the terms and conditions of the credit card application. But usually, for the most part, personal loans, they do get started with the higher rate. And if you're enjoying this episode, do not forget to hit the like button right here so you can help this video rank and help others like you who are looking for this type of information. Now, back to the tablet. You might be wondering, okay, now that I understand the differences, I'm still not clear on which one is better, right? Like, which one do you prefer? And I have to say that it all depends, right? The so commonly famous depends. Why? Because we don't all have the same circumstances. We'll have different needs. That's why it's important to educate yourself and to understand the pros and cons of each and one of these different lines of credit. So that way you will know which one to implement when the time is right, or perhaps even use them both, right? Typically, I lean more towards using a credit card. Why? Because I don't want to deal with having to apply for a line of credit every time I need to use it. With the credit card, I can use it, I can pay it off, and then I can come back a year or 6 months later and then use it again without having to go through the entire application process, putting my information, my social security number, my address. It's just, even though it's fast, it takes time and effort from your busy schedule for you to come out of your way to fill an application. So why would I do that if I have access to a credit card? Another reason why I tend to lean more towards the credit card route is the fact that you can have multiple credit cards, right? So I'm just gonna draw a line here. And I'm sure you've seen in a couple of episodes prior to this one where I actually talked about the number of credit cards I have, 30+ plus, 30 and above. You can have as many credit cards as you like. There's really not a limit as long as you do it right? You apply gradually and you maintain all those credit cards gradually. So you can have lines of credit that can stem back from 10 years ago, 20 years ago, and you can have new lines of credit or new credit cards in this case that could be 2 years old or maybe 6 months old, but you don't really have a limit. And if you do, it's usually a double-digit limit, right? As opposed to personal loans, you can have 1 or perhaps even 2 max. You don't get to apply for personal loans over and over and over again because, like I said, it's something that is not forever. You paid it off and then it gets eliminated. So it's very difficult to keep up and maintain. It's more maintenance on the bank side, having to create a new loan and then close it, create it and close it, create it and close it, especially if it's for a such period of time, as opposed to a revolving line of credit, a credit card that will go around and around for you to use for as long as you like, until you decide to close it, cancel the credit card, or just mess everything up, right? And that is pretty much it. That's all I have for you today. Hopefully you found this episode valuable. And while I still have you here, do not forget to check out this video right here. That's gonna help you complement everything you just learned today. And until then, take care, bye-bye.